Why do profitable construction companies still fail to meet QBCC's financial requirements? Hi, I'm Len, your trustworthy accountant. QBCC's perspective different from many business owners when reviewing financial statements. From the owner's perspective, the first thing they usually look at is, did we make money this year? How good are the profits? But from QBCC's perspective, it looks at, does your company have sufficient financial capacity to continue operating, bear risks, and fulfill its debts? Why do profitable builders still fail QBCC's audits? There are four main reasons. First, profit is just a result, not a guarantee of a solid financial foundation. A company's profitability only indicates that revenue exceeds expense at this stage. But QBCC looks at more than just profit. It also considers net tangible assets, the current ratio, and the overall balance sheet structure. Therefore, some companies, even if profitable, may still fail if their financial foundation is not solid enough. Second, profitability does not guarantee healthy cash flow. This is very common in the construction industry. Having a profit doesn't necessarily mean you have real cash on hand. Often, money is tied up in accounts receivable. Project payments are slow, but employee salaries, material costs, subcontracting fees, and various short-term liabilities still need to be paid. So while books may show a profit, liquidity is actually very slow. What a QBCC values most is your ability to solve your short-term debts. Third, a large business size doesn't guarantee that your current financial strength can support it. Some builders have grown rapidly in recent years, with impressive revenue growth. However, the problem is that revenue growth must match your net asset level. If revenue exceeds your financial capacity, even if the company is profitable, it may still not meet QBCC's requirement. Fourth, financial compliance isn't just about numbers. It's also about reporting. Some companies may have no major operational problems, but if they don't submit annual report on time, or if their financial statements, disclosure methods, and accounting treatments don't meet QBCC requirements, they will still run into trouble. Therefore, failure isn't necessarily due to a lack of profitability, but to non-compliant reporting or inadequate financial documentation. The essence of this issue is that QBCC assesses a company's overall financial resilience, not simply whether it has a profit this year. In other words, profitability reflects operating performance, but QBCC financial requirements assess financial strength and compliance capability. We are experts in QBCC compliance and advanced tax planning. We help you move forward with clarity and confidence. Remember to click like, save, and follow.